Welcome to The Explainer. Today we're popping the hood on Automotive Properties REIT. Now, it's flashing this really tempting high yield, but the big question is, can it actually deliver that long-term growth? Or is there something a little risky kind of lurking underneath? Let's find out.
Okay, so let's get right into it. The central question we're trying to answer today is pretty straightforward. Is Automotive Properties REIT a reliable, steady Eddie income play for your portfolio? Or, is that slow growth and pretty heavy debt load a bit of a red flag? So here's how we're going to tackle this. We're going to follow the path of an analyst. We'll start big picture. What's the business model? Then we'll zoom into the valuation, go really deep on the financials, weigh out the pros and cons, and then, finally, we'll land on a very specific price target and a final verdict.
All right, first things first. Let's get a quick handle on the core business. And you're going to see it's actually a surprisingly simple and honestly pretty smart model.
So, this company is what's known as a triple net lease REIT. REIT just stands for Real Estate Investment Trust, but that triple net part, that's the key. Think of it like being the ultimate hands-off landlord. I mean, you own the building, but your tenant, in this case it's a car dealership, they pay for literally everything. Taxes, insurance, all the maintenance, the whole shebang. This setup is designed to create an incredibly stable and predictable flow of income.
And here's their business model in 3 simple steps. It's actually kind of beautiful. Step 1, they buy car dealership properties in really good locations. Step 2, they lock those dealers into long-term triple net leases. And then step 3, well, they just collect the rent. Which, by the way, is not only super stable, but often has rent hikes built right in that are tied to inflation. It's a very simple, very effective cash-generating machine. Okay, so now let's shift gears and talk about valuation. Let's see what the numbers tell us. Is this company actually trading for a discount to what it's really worth?
All right, now this is where we get into the real numbers. We've run 2 different models to figure out what this company is worth. The first is a discounted cash flow, or DCF, which basically looks at all the cash it's expected to make in the future. That gives us a value of $11.80. The second model gives us a slightly higher value of $12.40. Now, look at the current stock price, $11.39. Do you see how incredibly close all 3 of those numbers are? That tells us something really important.
And here's the crucial takeaway from that. There is practically no margin of safety here. It seems like the market has priced this company almost perfectly. So, at its current price, you're really not getting some hidden bargain. You're pretty much paying exactly what it's worth. Okay, time to go a little deeper under the hood and check out the company's financial health. And, well, this is where we start to find some of the things that the market is probably a little worried about. The very first thing that just jumps right off the page is the debt. I mean, look at this. The company is carrying $647 million in total debt. That's actually more than its entire value on the stock market, which is $618 million. That is a significant debt load and, for sure, a major risk factor to keep in mind. And this slide, wow, this really paints a picture of the cash situation. The company's payout ratio is almost 99%. So what does that mean? It means for every single dollar of cash that comes in the door, nearly that entire dollar goes right back out to shareholders as dividends. That leaves practically nothing left over to reinvest, to pay down that debt we just talked about, or, just to have a safety cushion. But it's not all doom and gloom. There's a huge positive here, and that's management. Their interests are super aligned with shareholders. Why? Because insiders own a whopping 49% of the company. That means they have serious skin in the game, which is a massive vote of confidence. Okay, so let's pull back for a second and see how all these different pieces, the good and the bad, balance each other out. It's time for a classic SWOT analysis. Strengths, weaknesses, opportunities, and threats. This weighted analysis really tells the story perfectly. You can see the big strengths, that super stable cash flow and the high yield, they score really well. But they get pulled down significantly by that weakness of high debt and the very real threat of interest rates going up. So the final score, 5.95, it kind of suggests a company that's pretty balanced with moderate risks and moderate rewards. So let's be really clear here. That stable income is awesome, but it definitely comes with a list of risks. We've talked about the high debt and the interest rate sensitivity, but there's also that crazy high payout ratio, the fact that all their tenants are basically in the same business, not a lot of obvious ways for them to grow from within, and not a whole lot of cash just sitting around. That's a pretty hefty list of concerns for any investor. Okay, so Taking that whole picture into account, the business model, the fair valuation, all those risks, let's get practical. What price would we need to pay to make this a really compelling investment? Specifically, let's say our goal is to get a 9% return every year.
This table is super helpful. It basically lays out the ideal buy price you'd need to hit different return goals over the next 16 years. So if we look for our 9% annual return target, you can see the analysis shows we'd need to buy the stock at $9.50.
And that right there, that is the key number from this whole explainer, $9.50. Now remember, the stock is trading right now for around $11.40, so our target price is way lower, which just drives home the point that right now, it's just too expensive to hit that 9% goal. Now, this is really interesting. Check out how your personal timeline changes the price you can pay. To get that same 9% return, you could actually pay more for the stock, like $10.80, if you only plan to hold it for 5 years. But the longer you plan to be an owner, the lower your buy price needs to be today to make up for that slow growth. It just really shows how important it is to be patient and wait for the right entry point. So after we put it all together, the business, the valuation, the risks, the price targets, what is the final call? What's the bottom line here on Automotive Properties REIT? Okay, the final verdict is a hold. Look, it's a solid company for generating income. There's no question about that. But the current price is just too high to feel confident about hitting that 9% return target. So the advice here is to keep it on your watch list and maybe think about buying some shares if the price drops, ideally somewhere below that 1050 mark. And that really is the main takeaway. You should think of this company like a textbook income stock. It gives you stability, it gives you a great yield, but it is not a growth engine. At the current price, there's just no room for error and very little chance for your investment to grow much in value. The best move is probably to be patient and wait for a better price. I really hope this breakdown was helpful for you to kind of see all the moving parts of this company. But now, I'd love to hear from you. What company should we put under the microscope next? Go ahead and drop your suggestions in the comments below.